There are a few investing blunders that many people make, mistakes that are detrimental to their overall investment strategies. Here are the deadly sins of investing that you should avoid. Number 1, not taking your goals into account. Make sure that the investments in your account and their risk levels reflect what you're trying to accomplish. Number 2, basing your investment strategy on someone else's risk tolerance. You wouldn't buy shoes based on someone else's shoe size, would you? So why would you copy your friend's portfolio holdings without taking into account your own goals and your own risk tolerance? Number 3, making too many short-term moves with your long-term money. While buying and selling stock can be fun, it should be done with money that's not intended for your long-term goals. If you're really set on a short-term buying and selling strategy, open an account that's just for play money, leave the rest of your serious money in well-diversified long-term investments. Number 4, tying up too much in one investment. If your income depends on your paycheck from a company, make sure your investments don't also depend too heavily on the same company. A good rule of thumb is to have no more than 20% of your investments in any one company's stock, and ideally, this would be closer to 10% or less. Number 5, not knowing what you're actually invested in. You don't need to know the exact stocks and the balanced mutual fund that you have in your 401k, but you should have a general idea of what's in your portfolio. If you use a financial advisor to manage your assets and you have no idea what they're doing with your money, ask him or her to break it down for you in simple terms or graphs and charts. Number 6, basing investment decisions on the news. You can't predict what's going to happen in the market based on what you read in the news. It can't tell you that the stock market is really going to tank tomorrow and that you should sell everything and go to cash. Research has shown that having a well-diversified portfolio that you leave alone is a better strategy than trying to time the market. Number 7, not saving enough. And this is a big one. If you aren't saving enough, it's going to be really hard to get to where you need to be. So make a plan to bump up your savings. You don't have to go from 5% to 15% all at once. You can set up automatic increases of 1% every 6 months until you get there. A certified financial planner can help you avoid these 7 deadly sins and help your portfolio thrive. Schedule a complimentary consultation today at yourrichestlifeplanning.com.